Good morning from rainy and cool Chicago. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money bi-weekly podcast. Today is Sunday, June the 14th, 2026. Before we begin, just a couple of fast announcements. In July, my son Jack and I are going to be presenting, I think this is our 11th annual mid-year investment outlook. You can see it right here on the page. You can sign up for free, by the way. If you go to fidelityevents.com, you can see the URL. If you can't see it, contact us at asburyresearch.com and we'll send you that link. It's Wednesday, July 29th, 2026. So coming up in just a little bit. Also, next week, I'm going to have my monthly interview with Sam Vadas, who is one of the talking heads at the Schwab Network. It's usually about 10 minutes after 9 in the morning. This will be Wednesday, June the 17th. Again, typically Chicago time, about 10-15 minutes after 9. And I'll be looking at the markets then. So let's get down to business. Since our previous Follow the Money podcast, which was exactly 2 weeks ago, the stock market has been driven by a broadening risk-on environment led by semiconductors, AI-related stocks, growth shares, and small caps, reflecting confidence and continued economic expansion. Investors have largely looked past the Middle East geopolitical situation, treating it as a temporary disruption while focusing on strong technology fundamentals and improving market breadth. Falling oil prices, low volatility, and stable credit conditions have further supported risk assets by easing inflation concerns and reducing pressure on interest rates. Overall, market action continues to favor cyclical growth opportunities over defensive positioning, indicating a constructive outlook for both the economy and equities. Technically and quantitatively, however, there are several signs of emerging internal weakness, which we are going to take a closer look at in today's podcast. The stock market will begin next week sitting right on top of some critical underlying support levels in most of the major indexes across the board. If the market can't rebound from these support levels, and again, we're going to identify them for you in just a few minutes. If it can't rebound from these levels over the next few days, a corrective decline is likely to begin, a very overdue one, I might add. Before we get into more detail and start looking at some key charts, data series, and our own quantitative rules-based models, let me take a minute to just tell you a little bit about Asbury Research. Asbury is a registered investment advisor. I launched Asbury Research in 2005 after spending 25 years in the business, most of it on the trading floor of the Chicago Mercantile Exchange, which I call my university. That's where I really learned how the markets work from the inside out. It's a great education. Asbury has been providing investment research to both individual investors and professional money managers since 2005, utilizing what we call intelligent diversification, an actively managed approach that was designed to constantly adapt to changing market conditions. And we've seen a whole lot of those lately. Changing conditions, rather than relying on traditional static set it and forget it allocation models, which is typically what you might get from your average advisor. And we just don't believe that works well anymore. We want the markets to tell us when we should be aggressive and when we should be risk off, and not something that we set up a year and a half ago in some guy's office that we don't see very much. For self-directed investors, Asbury offers both its flagship Asbury Premium Research Service and also a lower-cost Substack newsletter. We're going to take a closer look at the Substack at the end of today's podcast. For investors who prefer a managed account, we have created 5 model portfolios using our own correction protection model, or CPM as we call it, and our CEF model, which is our sector rotation model, as the building blocks. These model portfolios have undergone extensive backtesting and have been trading in real time for nearly 2 years. Year to date, Let's move to our graphic. Here we go. Year to date, our Asbury Aggressive and Asbury Conservative model portfolios have outperformed the S&P 500 with half the maximum drawdown that we've had in the S&P and a lower standard deviation than the S&P 500. Better performance with less risk is really hard to do in the markets. Typically, this kind of performance usually gives you better risk-adjusted returns, which usually equates to a better Sharpe ratio, a higher Sharpe ratios. On many of our models, our Sharpe ratios with a multi-year look back, they hover around 1.0, which is a very, very good Sharpe ratio. Full disclosure, all of my own equity-related investment dollars are invested in Asbury Research models. I don't do any stock market investing other than in our own models. Now let's get to the reason that you're here, and let's get back to asburyresearch.com and have a look at some of our models and see where we are. So we're now in the Research Center. This is the paywall, and we're going to scroll down, and we're going to look at the Correction Protection Model, or the CPM. So the CPM right now is risk off as of June the 5th. Year to date, CPM has outperformed the S&P by 2.1%. CPM was the first model that we ever built, and it's undergone, I guess, a few updates. Markets change, and we change with them. We're constantly looking at our models and making sure they're working, making sure that the constituent parts of the model are still responding to what the markets are doing. It was created to replace that set it and forget it 60-40 static portfolio that I talked about, which again, we don't think it really works anymore. In March, for example, S&P 500 went down, bond prices went down, and gold prices went down. So if you were waiting for your gold or your bonds to rescue your stock portfolio, didn't happen. Over time, CPM tends to stay with the market with less risk. Let's go back here and take a look at one more picture that I'd like to show you. So this is looking back to the middle of 2018. The purple line down here, that is your 60-40 portfolio. There's an ETF for that now. The ticker is AOR. So that's what 60-40 looked like from the middle of 2018 through just a few days ago. The S&P 500 is up here in orange. This in blue is our Asbury balanced model portfolio. And in green, this is our ultra aggressive model portfolio. So I just wanted you to kind of see the spectrum, see them all together. I'm a visual learner. Things make a lot more sense to me if I can see the pictures. So this is kind of where our model portfolios are relative to a 60-40 and to the S&P 500. Next thing we're going to do, we're going to go back to the website and back to the Research Center, and we're going to look at our SEAF model right here. SEAF stands for Sector ETF Asset Flows, and there's the graphic. SEAF, current signals, are healthcare, real estate, and materials. These have the best composite scores. The way we read this is, let's look at healthcare up at the top. Healthcare, by the way, has been in the doldrums for a while, and it just popped up into the number one spot over the past week. There's been a lot of money flowing in there, particularly in the trading week where it was the second strongest, and the tactical month where it was the second strongest. It's only eighth in the strategic. So this is a lot of new money coming in, a lot of strength. If you add these up, it adds up to 12, and 12 is our top ranking. And the reason it ranks higher than the other two, which are real estate and XLB, which is the materials sector here down at number 3, is because when we have a tie, so to speak, we want to pay attention to the most recent data. And the most recent data is over the past trading week, and this has the best score. The lowest scores are down at the other end of the spectrum here. The weakest sectors, the places where the money is coming out of to go into those top three, they're coming out of energy and they're coming out of communication services, XLC. You can see them right here on the bottom. So the SEAF model, if you're not familiar with it, it's a completely data-driven sector rotation model created to quantitatively identify long / overweight opportunities in U.S. market sectors. These are the 11 sector spiders, which together comprise the S&P 500. If you put them all together, it's the S&P 500 broken into 11 different sized slices. Basically, what we're doing is I built an algorithm years ago that measures the velocity of money as it's moving around those 11 components of the S&P 500. And all we're doing is following the money. We want to be in those sectors where the money is moving into, and we want to avoid the sectors where the money is coming out of, like those two on the bottom that I talked about a second ago. SEAF is always fully invested in the market, providing investors with a dynamic market conditions generated alternative to the traditional buy and hold, set it and forget it portion of your portfolio. We're always in the market in SEAF. Year to date, in real-time trading, SEAF has outperformed the S&P so far by 2.4%, with approximately 37% less maximum drawdown this year. Next thing we're going to do is we're going to move to one of the reports in the premium service. And this report is called Keys to This Week. Let's get back up to the top. This is one of our regular reports. This usually comes out near the end of the week, and Jack and I probably look at 150 charts and try to put 10 charts together that we think are the most important for where the market is right now and what's happening in the market. It changes. So it's just like building a house. You use different tools to do different jobs, a screwdriver and a hammer and a wrench or whatever it might be. And the same in the market is we look at a lot of different charts, and we try to do this once a week to let our subscribers know what's important right now, which is not necessarily what was important 3 weeks ago or maybe important 3 weeks ahead. But here's a few of those charts. The first one is just a simple underlying support level type of chart for the S&P 500. Big takeaway here, 72.31 is where the 50-day moving average is. That is a widely watched minor trend proxy, and you can see the market sees it. It's been sitting on there for 3 days. We had some announcements out of the White House that we were no longer going to attack Iran. It seems to change every 3 days, but that was enough to push the S&P off of the 50-day moving average. 72.31. It's a big level to watch. Minor overhead resistance is 74.68. That's just a simple 21-day moving average. We think it's important right now because it's really defined the minor trend in the market since April. If we break 72.31, the next level of support is around 7,000. That is the high that we made back in January. The other interesting thing that this chart does not show is that most of the other major stock indexes, including the NYSE and the Dow 30, both of the NASDAQs and the Russell 2000, they're also testing their 50-day moving averages. So it's really important what happens next week. If the market can hold here, this is the likely launching pad for the next leg higher to new highs. If it can't, we have a problem because, again, it's not just the S&P that's sitting on this level. It's pretty much the whole spectrum of the major indexes that we track. So again, 72.31 is our focus for next week. This chart, the most important part of this chart is in the lower panel. It's got DIA up on top, DIA, which is the ETF that tracks the Dow 30. Down at the bottom is the corresponding relative performance chart between DIA and SPY, which is the SPY is obviously the ETF that tracks the S&P 500. When the stock market is strong, when When investors are confident, they're feeling good about the market, they usually don't want to be in the Dow. They want to be in the faster horses. They want to be in the NASDAQs. They want to be in semiconductors. So you can see here from April 10th to June the 2nd, the Dow is underperforming the S&P 500 on a 21-day basis. Why 21, John? Because it's Asbury's tactical time period. When you're looking at indicators, you need to know what your time period is. Tactically for us is 21 days. Strategically for us is 63 days. 63 days, the trend we're trying to catch, and the 21-day is how we do it. Look what's happened since June 2nd. The Dow is starting to outperform the S&P 500 again. Generally, when that happens, the market is starting to get nervous. It's maybe moving away from some of those faster horses and be on the more sure-footed Dow. So this is negative in here. As the longer the Dow keeps outperforming SPY, the more indicative it is of a market that's getting a little bit nervous internally, even though you might not be able to see it on the S&P 500. Internally, the market is starting to rearrange how it wants to invest, and it's going towards defense. The next one, this is the same chart, but now we're looking at the NDX, which is the NASDAQ 100, which is where all the big tech stocks are, where a lot of the AI-driven stocks are. Look what's happening here. Since April 8th, NDX started outperforming the S&P 500, just like the Dow on April 10th started underperforming the S&P 500. It's the same message. This indicated an increase in risk appetite that you see. Just moving a couple things around on my screen here. But since June the 5th, NDX is starting to underperform SPY. Again, this indicates that investors collectively are getting a little bit nervous. They're moving out of technology and they're moving into the Dow. Again, oftentimes you see these kind of under the covers or under the hood changes in the market's character before you actually see weakness on a chart of the S&P 500. That's something we're watching. This is the SOX index. The SOX index has been the constant this year in terms of outperformance, and it has largely kept the S&P 500 from going into a deeper decline earlier this year. Look what's going on. On March 19th, the SOX started outperforming SPY. And we had a strong move higher in the SOX and all the other indexes. On May 18th, it tested that 21-day trend. That was a minor bottom in the SOX, but it really didn't do much. Got a little bit higher, but now we've fallen back into that 21-day moving average on a relative performance basis. This means the SOX needs to pick it up next week, right away, or it's losing its major driver that it's had since March. So these are three really important charts to keep an eye on. The last one I want to show you here is the VIX. This is VXX. This is a VIX derivative of sorts. VXX is the IPAF Series B S&P 500 VIX short-term futures ETN. It's a sentence, has a sentence for a name. VXX is designed to provide investors with exposure to one or more maturities of futures contracts on the CBOE Volatility Index, or VIX. I like to use this one at times because it's a little less volatile. Here's the message. On April 8th, VXX dropped below its 21-day moving average. That means on a monthly basis, the market started becoming a little less fearful, and that resulted in a strong move in the S&P 500. It's only been above that 21-day moving average one day on June the 10th, and now it's slightly back below it again. 2562 is the level. It's a 21-day moving average. If VXX, and you'll see this in the VIX also, if VXX starts to rise over the next week or two, we are likely to see a move down just as we did here. VXX going up, S&P 500 going down. It's really close to there. Any kind of a minor scare, that comes out of the White House or comes out of the Middle East is enough to do the trick there. So really watch volatility next week. Remember, we got that 50-day moving average right under the market. If the VIX starts to rise and we break those 50-day moving averages, it's going to motivate more selling. And that's something I think that is really important for us to look at. Finally, let's take a look at our Substack product. I told you that we would touch on it. So the cost of this is entry level. This does not have all of our models and all of the premium research, but it does have a sampling of the premium research product, and it also has its own quantitative sorting device to show us which parts of the investment universe are in favor. It's $25 a month. There's also a free version. If you're subscribed, which if you're not, you should do it today. If you're subscribed to the Follow the Money podcast, you should be getting this for free. AsburyResearch.substack.com. Sign up. It's free. It'll teach you more about Asbury's approach to markets. There's three different reports here. The first one is called Chart Focus, and that is right here. And this is very similar to Keys to This Week. It's once a week, and it has a lot of charts. Here's the DIA chart, the one we looked at with the relative performance of the Dow versus the S&P. Another aspect of the service is our sort report. The sort report is the quantitative scanning device that I told you about. Let's make it a little bigger. What we do here is we've got a wide array of different investment vehicles. We've got the US dollar, crude oil, interest rates, US tech, US small cap, global equities, emerging markets, commodities, gold, and crypto, which I do not trade, but I know other people do. What we've done here is we've come up with three criteria that for us are really kind of benchmarks of what we do. We want the trend to be up. We want relative performance to be positive. In other words, we want these assets to be outperforming whatever their benchmark might be. In many cases here, it's the S&P 500. And third, money flows. These are all ETFs. So we're tracking the AUM. We want the AUM to be expanding, showing us that there's money coming into these ETFs, which is the fuel that keeps them going higher. Right now, very atypically, none of these have three all the way across. We have some that have two. US dollar, we have US interest rates, and we have US tech and US small cap. That means scanning thousands of ETFs, these are the ones that are performing the best. It's better if all three are green all the way across, but this comes out twice a week and it lets you know what is working. So when you're trying to determine what you want to buy, you've got a quantitative screen telling you where you should be looking for opportunities. The third one, let's back out here, is new. It's a rainbow chart report. Rainbow charts are the corresponding charts for the SEAF model. And the way they work, let me find one here that's a really good example. Healthcare. We said healthcare is number one this week according to SEAF. Look what happened from March the 5th. With just a few exceptions, healthcare has been in a void territory, let's call it. This, by the way, this is the daily SEAF score going back one full year. This is one full year, and you can see how it kind of oscillates from a void to neutral to favored and back again. Down here is the corresponding daily relative performance chart of XLV versus SPY. Is it outperforming the broad market or not? From March 5th up until a couple of days ago, it was almost always, a couple of times it popped up into neutral, but for the lion's share of this, it was in a void territory. And look what happened. XLV underperformed the S&P by 15% during this period. Look what's happening now. It's starting to edge its way into favored territory. That's really important because the last time that we were in favored for an extended period in healthcare was basically middle of October through middle of December, right here. And that gave us this relative performance. This is showing us where the money's going and telling you and showing you so you can watch these trends develop. So you could be on top of these trends and understand that, like, healthcare has been in the doldrums for a long time. It's starting to pop its head up. It's an opportunity. We'll see. We don't know where the money's going to go next week. It hasn't happened yet, but this is 3 charts that you get once a week, and we choose 3 of the 11, and you can start to watch the CEF model and watch these trends of asset flow start to develop. So that's it. That's it for today. That wraps up our latest Asbury's Following the Money podcast. The next one is going to tentatively be scheduled for 2 weeks from today, Sunday, June the 28th. I hope to see you again then. In the meantime, if you have any questions about or want more info on any of our research subscriptions or managed account services, you could contact us right here, asburyresearch.com. Use the contact tab. There's more information about managed accounts here and more information about the research aspect of our services here. I'll see you right here in 2 weeks. I hope they're good ones. I think it's going to be an interesting market for these next couple of weeks. Thanks again for watching. Have a great rest of your Sunday, and don't forget to like and subscribe.